Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. Obviously, all of the news focused around the tariffs that were announced yesterday afternoon. We're just going to dive right into what those tariffs were, what they all mean, and more importantly, what it means for the market overall. So the administration came out and announced a 10% sort of blanket tariff across all goods coming into the United States, with a couple of country exceptions for people that are already tariffed. But then also announced these sort of reciprocal tariffs on a lot of our trading partners that were meant to reflect the size of the trade barriers that they have in place with us. And it's very opaque, sort of what that calculation exactly was. The administration hasn't disclosed the exact methodology that they used to determine what the size of the tariff on each country was. But it does seem that those targets are related to the overall size of the trade deficit that we have with those individual countries. So, for example, you take a country like South Korea, their effective tariff rate on imports is it's less than 1%. They have very, very open borders. However, we have a very substantial trade deficit with South Korea. And so the administration claimed a number that was more like 50, and we put a 25% sort of retaliatory tariff on South Korea. So it seems pretty clear that what the administration is doing there is they are targeting the areas in which we have trade deficits and putting those tariffs in place on those countries. Notably, that impacts places like Europe, Japan, China. Some of our largest sort of sources of imports will receive the largest tariffs. And that actually makes for sort of a larger impact if you think about it, because it's the countries where we're importing the most goods from where the largest tariffs are going into place. It's estimated that 10% tariff, that's going to take our effective tariff rate for goods coming into the United States from about 10% up to about 23% is our best guess right now. But once again, as we'll talk about a little bit later in the market update, that's a very fluid number. Now, in static terms, and you're seeing a lot of this being thrown about in the media right now, in static terms, if we just took all the trade as if it's happening the same way it's happening today and slapped all these tariffs on it, you would realize about $400 billion in revenue from the imposition of the tariffs. That's about 1.3% of GDP. And just so everybody's clear, the way that's kind of reflected is that prices go up, right? Goods are still imported across the border. A tariff is imposed on those goods. The prices of those goods rise. And so the American consumer actually pays for that tariff to some degree when they purchase those imported goods. And if you view it that way, it's kind of akin to a sales tax, right? We're putting a sales tax on goods that come into the United States from foreign countries, which are paid for by U.S. consumers if they buy those foreign goods. If you view it that way, it is an incredibly large tax increase. It's actually the largest tax increase since 1968, since the Revenue Act of 1968. And I just say that so that everybody gets the magnitude of the scope of the numbers that we're talking here. This is kind of a big deal. Now, that said, some categories of goods are going to get taxed more than others. Certain goods that we import from Europe or certain goods that we import from Japan or China will face different tariff rates than others. Generally, across the board, when you mix it all together, our best guess right now is that it would raise prices sort of across the board for consumers by about 1.5%, with most of that price increase coming in the second and third quarters of this year. And, once again, that really kind of just depends on what good you're looking at. You will see some dramatic jumps in the prices of some goods, some relatively small or non-existent jumps in other prices. But seems clear that if these tariffs stick around, we will see prices go up. And as a result of that inflation, you are seeing a lot of the Wall Street big firms start to call for, hey, this might trigger a recession. I just want to be clear, we're not there yet. It was not the first time that a lot of Wall Street banks have called for a recession. One remembers sort of the 2023 episode where every bank was calling for a recession by the end of the year. That didn't materialize. We've still got a lot of time left to play through this entire thing. So I just want to be very, very clear on that. But you are seeing a lot of people say like, hey, on a static basis, 1.5% of GDP, 1.5% price increase. This is a big deal that impacts consumers in a big way. And I will just note, once again, from a market basis standpoint, since we're talking about, an increase in the CPI across all goods, it tends to disproportionately impact lower income populations, which is actually somewhat important as you think about the overall market, because those populations aren't likely to be saving much money anyway. And so actually the impact of that 1.5% inflation, once again, complete values judgment aside, the fact that it disproportionately impacts lower and middle income populations as opposed to higher income populations is actually a good thing if you think about consumer spending, because presumably those higher spending households can just sort of roll through this without it being too much of a problem. Once again, that's not a values-based judgment. That's just a judgment on how it impacts overall market spending. It's also important to note that this isn't static. All of those numbers that I just quoted are, as if everything just stays the same status quo and goes forward with the tariffs in place. That is highly unlikely to happen. The first thing is we haven't seen any type of retaliatory tariffs against us based on these new tariff packages. It seems very likely, if you think about nationalism, that a number of our trading partners are not just going to say like, okay, please roll over and, I'm gonna do whatever it takes to make you happy. To do that is not really appealing to their own political base. And so it's likely that we're going to see some retaliatory measures against us. That's why they call it a trade war. The administration has claimed that some countries have already started to reach out to them about negotiating, around what these tariffs look like. And certainly Canada and Mexico, if we look back at what happened in sort of the March-April timeframe, there was obviously the administration's willingness to, make a couple of examples of, okay, hey, you made this concession, and so I'm going to adjust your tariff rate, et cetera. We haven't seen any of that yet. And that makes all of this very, very uncertain. A lot of people will say, okay, we have certainty now. I think actually the opposite's true. We have a lot of uncertainty in terms of how long will these tariff packages play out? What's the response of our trading partners? How do we respond to that response? It's a very fluid and evolving situation. And I just want to note that uncertainty is likely to create some uncertainty in terms of overall business spending and investment. If you think about a business deciding to build a manufacturing plant or deciding to invest capital either here domestically or abroad, they generally do so with a 15, 20, 25-year plan for what that particular investment is going to do. And in light of this sort of, constantly evolving network and framework of tariffs and trade barriers and costs, et cetera, you're likely to see a lot of people just say like, I'm going to sit on the sidelines for a little bit until I figure this out, which is important because, that's going to factor into a little bit of the economic, I will say, fear later on in the year. Does this disrupt investment decisions? Does it take a little while for companies to start to, if the tariffs are permanent, does it take a little while for companies to start to invest in the United States, et cetera? We'll just have to see. With all of that said, I will just tell you that obviously the markets are not super jazzed by the creation of this uncertainty. I will tell you that it's really, in my mind, more the uncertainty of everything that's going on as opposed to, the true dramatic impact. S&P 500 down about 4% at the open. That's about minus 12% peak to trough, down about 7.5% for the year. Not terrible, right? If I think about the peak to trough drop, we're in correction territory. As we've mentioned previously, corrections are pretty common. They happen about one time a year. This is a pretty dramatic move in the indexes, but not that uncommon. There's actually been about 6 or 7 of these magnitude of moves since 2020. So, it's not like we haven't seen this type of volatility before. And then if you start to look at other asset classes, you can look at sort of, small cap, mid cap stocks. The Russell 2000 down about 5.5% today. That makes sense. Those are stocks that are a little bit more sensitive to imports and manufacturing and overall inflation and costs. But then if you start to look at, diversified portfolios, you'll see, international stocks only down about 1.3%. So, much better than domestic equity market performance. And then bonds, as people start to run to safety, those are up about 70 basis points, so 0.7% on the day. So those behaving exactly as you would expect them to affect, inversely correlated with equities when people start to get fear. And I would just note that now is not the time to freak out with your portfolio. If you are invested in a diversified portfolio, these diversified portfolios are designed for exactly these types of scenarios. This is why you own bonds in your portfolio. This is why you own different types of asset classes, not just the S&P 500 or the Mag 7 or any one of these other things. The reason why we have a diversified portfolio is to help to smooth out these types of bumps. And actually, right now is I will say it's one of the most dangerous times for your portfolio, but not for the reason you think. It's one of the most dangerous times for your portfolio because now are the times when people start to generally make poor decisions. And the decision to sell out or the decision to, get significantly more conservative and then potentially miss a rebound, et cetera. The data has pretty consistently shown that market timing is very incredibly difficult to do. Most people get it wrong. And so I would just encourage everybody, this is the reason why your portfolios are constructed the way they are, assuming you're holding a diversified portfolio. And so it's important to kind of take a little bit of time, get a little bit of perspective, and kind of stay the course with respect to your portfolio. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.